Hello and welcome to MasterChartsTrading.com market recap for Friday, September 25th, 2015. This week we'll look at a bearish rising wedge that continues to play out in S&P 500. The S&P 500 itself very likely has entered the bear market. We'll look at what some of the definitions of the bear markets and also at the chances of bear market actually happening right now. The AD line for XLY broke down. We'll look at that. Healthcare underperforms general market, and we'll look at also at biotech, which got pretty much taken out of the woodshed this week. So far, bonds got rejected at the 200-day moving average, and we'll see if that is going to hold or not. And then we'll look at gold and gold miners, and looks like they may be headed higher. Okay, so let's look at the S&P 500 large cap index. Showed this chart in the past. So far the dominant feature still of this chart is this major breakdown we had in late August and then a rebound that followed. The rebound took a form of rising wedge, and if we now assume that S&P 500 is bearish, this rising wedge and the subsequent breakdown is a bearish omen, bearish sign. So looks like we did have a bearish breakdown in this wedge last week, and then all this week we pretty much followed lower. Now for now looks like the support here is holding, but I'm not sure for how long or if it will hold or not, because some of the other indicators I follow, I'll show later in the show, may be indicating that we are actually entering a bear market, which may extend further, and I'll look at what bear markets in general are. Okay, so some of the breadth measures here. We have bullish percent index, and the S&P 500 stocks above the 200 EMA and the 50-day EMA, etc. They're all still firmly in bearish territory and are unable to get anywhere close to the bullish territory. Okay, next chart, we'll look at the actual Spdr SPY, S&P 500 Spdr. So here it's a little bit different chart because the previous one was of SPX of the index itself. Here I wanted to point out one interesting feature is this indicator, which is on balance volume. So looks like on Friday the on balance volume closed below its below the close that it set right here in August. So it looks like a divergence. In other words, the on-balance volume indicator made a lower low, while the S&P 500 has not yet made a lower low. Now, if we assume that volume leads price, this is an ominous sign, and we could potentially get further weakness in S&P 500. Also, new highs, new lows indicator is also still firmly in negative bearish territory. For now, the advanced decline line and the advanced decline volume line have not yet broken down, and they're still making slightly higher lows compared to the price itself. So far it has not broken down, but on balance volume looks like has already broken down. Alright, let's now zoom out a little bit and look at a very long-term chart of S&P 500 Spdr SPY. So on this chart I have removed the actual price of S&P 500 Spdr SPY and left only the moving averages in its place. So when the red moving average is above the green moving average, the stock market is in a bull mode, in a bull market, and vice versa. When the red moving average is below the green moving average, we have a bear market. And what is a bear market? It is a series of lower lows and lower highs, and a general decline of prices. And vice versa, the bull market is its opposite, when the prices are making higher highs and higher lows, and prices are generally moving up. So there is a school of thought that says that a bear market is a decline of 20% or more. I don't normally subscribe to that, and like I said, my definition is series of lower lows and lower highs. Here also I have market breadth indicator, which is a New York Stock Composite advanced decline volume line and Nasdaq advanced decline volume line with similar moving averages on it. And I'm using this market breadth data to confirm or deny my hypothesis that the stock market has entered a bull or a bear market. Now, on this chart we have 8 instances of major inflection points over the past since 1980, so 25 years. One of those instances in 1981 was not confirmed by market breadth, and it was a bear market, but it looked like the advanced decline lines were actually moving higher. And one more instance here in 2011, following the flash crash, we had a genuine whipsaw where we had a confirmation from both the breadth and from the S&P 500, but the market turned around and made an all-time high within a few years and continued making all-time highs until today. So we have here so far 8 inflection points. 2 of them turned out to be not that good, but the rest of them were very good. So it looks like we have a 75% chance that any one of those points would work. So it's 6 out of 8 chance. Now here on Friday, today, September 25th, we actually had a moving average crossover in S&P 500 where the red moving average moved below the green moving average, and it was confirmed by the market breadth model as well. So as of Friday, as of close on this Friday, there is now a 6 out of 8 chance, or 75% chance, that the market has indeed turned, and we are going to start making lower lows. Now, in this business, 75% chance is actually quite good, and I'm going to go with it until proven otherwise and actually look for shorting opportunities. All right, let's look at some of the sector ETFs out there. XLY, Consumer Discretionary ETF, quite possibly the most economically sensitive sector out there. Now, it's a very similar chart pattern to general market. We had a major breakdown and a rising wedge. Possibly we've broken that wedge right there with a gap down, and so far we're not able to recapture. But the point of this chart I wanted to show was that the advanced decline line actually broke down below the low that was made in August here. So it's now at 305.80 and it was at 306.90. So we have not yet made a lower low in the index itself, but the advanced decline line did make a lower low. So in the past, this indicated that this is kind of like a leading indicator, and we may be headed for a lower prices in XLY. Next chart, I wanted to show XLV, Healthcare Select Sector Spdr. Now this one was the weakest performer this week, lost over 5%, and the most I think very important is that it actually broke below and it closed below the August low. So now none of the other sector ETFs, I believe, this is one of the few sector ETFs that actually closed below the August low, and this is a support break in my book. And if we move below, the advanced decline line and the advanced decline volume lines both confirmed this breakdown. So this sell-off was broad within the healthcare sector. Now, if you were following the news, you may have heard that presidential candidate Hillary Clinton tweeted on, I think this is Monday, about the outrageous charges that the drug companies are charging for drugs, for life-saving drugs. Following this comment, we had I believe this is a 5% drop in XBI. This is a very broad biotech ETF. So I think there's over 100 stocks in this ETF. So this sell-off on Monday was very broad. And of course, you can see that there's also this rising wedge kind of business, and this large candlestick was the breaking of that wedge. Continued throughout the week, and then Friday we had a nasty sell-off to complement this Monday sell-off. So this total for the week was over 15% drop. On top of everything else, the relative ranking, relative performance of this ETF XBI now dropped very low to 22, so it's no longer a market leader. Volume is also heavy, and this is on balance volume. It broke below the August low here, so it's confirming the breakdown. All right, let's look at bonds next. TLT, iShares Barclay 20 plus year Treasury Bond Fund. So, I mentioned last week that we had what I think was a buy point in bonds that are, even though the 50-day moving average right now is below the 200-day moving average, I look at some of the other indicators and I believe that bonds are still bullish. So I was looking for buying opportunities, which did come materialize in here on September, I think this is 13th. We had a breakdown, but this was looks like a false breakdown, and then we rallied right back up. Now, here on Thursday, actually, we had what appears to be a rejection-like candle at the 200-day moving average, which was confirmed the next day by a drop lower. So I'm a little surprised at this, honestly, because the stocks are pretty, somewhat still under pressure, and usually money moving out of stocks are finding their way into bonds, but it's not happening as much as I was expecting, I guess. So I wonder if money is right now moving out of stocks and out of bonds, because bonds are, pretty expensive, honestly. So we'll see if any more weakness in stocks continues, and whether or not the bonds will be the beneficiaries of this of the inflows of cash from a sale of stocks. All right, let's look next at gold. So this is a daily chart of spot gold price, end of day chart. I still think this is a bearish security long term. So I'm still looking for shorting opportunities. Long term, so we had a nasty multi-year, this is a low and a breakdown lower, and then we had a counter trend rally right to the resistance level, which came right at this broken support, and gold backtracked. But then we found support here in in almost 1097 area here, and it appears that we made a higher low rather. So this is a good sign for gold bulls to see higher lows being made. And then we rallied from here again with a counter trend bounce, and again we came to this 1160 area. So again we are now at resistance. We did break above this resistance level, so that's a good, that's a positive sign. Now, we are, on MACD, for example, is already overbought territory, and this is a bearish security, so when MACD is overbought, I will be looking for shorting opportunities. However, as I'll show in the next chart, GDX, the gold miners ETF, may be signaling that there is more upside to this gold bounce. One more thing is I wanted to point out that this chart will soon be available to subscribers only, so please sign up at MasterChartsTrading.com for our mailing list and soon to be trading service. So GDX this is also a daily chart of gold miners ETF, GDX. It's a very volatile brother of gold. So same thing, we had a huge decline, multi-year lows here, found support in the $13 area, and this $13 area is somehow very important. Looks like we're testing the support repeatedly and for now holding. So looks like there's a lot of trading in this $13 area. And the latest test I think came just a couple of days ago. I mentioned last week that we had a hanging man candlestick with a close above this red line, which is a 50-day moving average. So this was a positive sign, but this candlestick was just not very inspiring to me. And then lo and behold, Monday we had selling, and looks like we came all the way down to this $13 area again and then rebounded. So Friday, if we count Thursday and Friday action, we can see here that we actually managed to close above the 50-day moving average for 2 days in a row. And this has not happened since late May. So this is a big achievement for GDX. Since this is very much a bearish security, this is like one of the first steps is to be able for security to close above the 50-day moving average and hold it there. Now we did hit a new low for advanced decline line just a few days ago, and similar thing for advanced decline volume line. So I was a little concerned here that we may actually break below this 13 level and close below it. We haven't done it yet, so we'll see where this is going. But interesting thing, accumulation. Looks like some accumulation is happening below the surface. This is unbalanced volume indicator is pointing higher, was making higher lows, and while the actual index itself is flat for now. All right, one more thing about gold miners is the gold miners bullish percent index, which was at 0 here in July and early August, and one more time in late August, early September. And both times when we came up from 0, we had first time we had a very nice sizable rally here, and the second time it was it was a feeble bounce, but as I mentioned above, I think we held support here in the $13 area. And if gold continues higher, GDX is sure going to follow. So right now, also one more thing, MACD, it's not yet overbought, not in the positive territory yet. So when MACD becomes overbought, I will be looking for shorting opportunities, but it hasn't happened yet. So my best guess at this point is that if this support indeed held, and it looks like we did close above 50-day moving average twice, and if this is indeed what happened, we're going to see a retest of this high here at $16 or so. If we hold here and don't collapse from here, then a next logical level would be around $18 for the rally to continue around $18. Because that's where the broken support is from, and the 200-day moving average comes in there as well. All right, let me quickly show you how to find us on the internet. Please go to MasterChartsTrading.com. We're about to start trade alert services, and looks like we have a firm date here on October 10th. So please sign up for subscribe to our mailing list, and you will be the first to receive promotional pricing for our trading services. We have a blog and video section, public charts, and social page as well. So we have on this link here, public chart page, we have most of the charts that you saw today. Sign up for our mailing list. If you have Twitter, Facebook, YouTube, or StockTweets accounts, please follow us there as well. That's it for this week's recap. Thanks for watching and have another great trading week. Bye-bye.